Hello everyone. Today we're going to talk about taxable and non-taxable income. The Internal Revenue Code describes types of income that are taxable and non-taxable. We will cover the most common types of both. We focus on various forms of employee compensation. Federal tax laws set forth that all income is taxable unless it is specifically included. An exclusion is not the same as a deduction. And it is important to understand the distinction because sometimes deductions and credits are phased out as a taxpayer's gross income increases. Excluded income, on the other hand, retains its non-taxable character without regard to the amount of the taxpayer's gross income. Most types of excluded income do not have to be reported on a tax return, although there are some notable exceptions, like municipal bond interest. An example is Marcus is a popular recording artist who earned more than $2 million of taxable income during the year. Because of his high income, many deductions and credits are phased out for him. On July 1st, 2022, Marcus is involved in an auto accident and sustains major injuries. Marcus sues the other driver and receives an insurance settlement of $95,000 related to his injuries resulting from the accident. The settlement is excluded from his gross income because compensation for physical injuries is not taxable to the recipient, regardless of his taxable income. Marcus does not even have to report the injury settlement on his tax return. Now, for calculating taxable income. For a taxpayer to figure out how much tax he owes, he first needs to determine his gross income. Gross income is all the income a taxpayer receives in the form of money, goods, property, and services that are not exempt from tax. In addition to wages, salaries, commissions, tips, and self-employment income, gross income includes other forms of compensation such as interest, dividends, capital gains, taxable fringe benefits, and stock options. Next, the taxpayer calculates their adjusted gross income, also known as AGI, by subtracting from gross income certain specific deductions or adjustments. Examples of some of these 4 AGI, commonly referred to as above-the-line deductions, include certain IRA contributions, certain expenses for self-employed individuals, deductible student loan interest, and penalties paid to banks on early withdrawals of savings. The amounts of a taxpayer's AGI is important because it helps determine eligibility for certain deductions and credits. Now I want to talk about what earned income is. Nowadays there's a lot of confusion with earned income and unearned income, and let's talk about that now. Earned income, such as wages, salaries, tips, professional fees, or self-employment income, is received for services performed. Unearned income includes interest, dividends, retirement income, taxable alimony, and disability benefits. Earned income is generally subject to Social Security and Medicare taxes, also known as FICA taxes. Now I want to talk to you about 2 important concepts. Let's talk about the constructive receipt of income. The doctrine of constructive receipt requires that cash basis taxpayers be taxed on income when it becomes available and is not subject to substantial limitations or restrictions, regardless of whether it is actually in their physical possession. Income received by an agent for a taxpayer is constructively received in the year the agent receives it. Here's an example. Logan is a landlord who owns several rental properties. On December 30th, 2022, a tenant delivers a $750 rent check to Logan's payment lockbox. Logan does not collect the rental deposits in the lockbox on December 30th and instead leaves town later that day to celebrate New Year's Eve. Logan does not actually take physical possession of the check until January 5th, 2023, the same day he deposits the check in his bank account. He is considered to have constructive receipt in 2022 and must include the $750 of gross income on his 2022 tax return, because the check was available to Logan at the time without any substantial limitations or restrictions. Next, I want to talk about the claim of right doctrine. The claim of right doctrine is a rule that governs the timing of income recognition. Under the claim of right doctrine, income received without restriction, over which the taxpayer has complete control, must be reported in the year received, even if there is a possibility it may have to be repaid in a later year. The tax treatment of the repayment differs greatly based on the type of income. If the taxpayer is self-employed, and if in the prior year it had been included as self-employment income, the repayment is deducted on Schedule C by reducing income in the year the amounts were repaid. An example of this is Marilyn is a fine art dealer who owns her own art gallery. In 2022, Marilyn sells a painting in her art gallery for $28,000. She properly includes $28,000 in her gross income and pays taxes on the income. On February 2nd, 2023, the customer discovers the painting is a forgery and returns the painting, demanding a full refund of $28,000. Marilyn promptly refunds the customer. Since Marilyn pays back the $20,000 in 2023, she is entitled to deduct the amount from her gross income in 2023. She does not have to amend her prior year tax return. Now I want to talk about garnished wages. An employee may have their wages garnished for various reasons, such as when the employee owes child support, back taxes, or other debts. It is important to know that regardless of the amounts of garnished wages from the employee's check, the full amount of gross wages must be included in his taxable wages at year end. Now I want to talk about another topic of, let's just see right here, Employee Achievement Awards. Employers may generally exclude from an employee's taxable wages the value of awards given for length of service or safety achievement. The tax-free amount is limited to the following: $400 for awards that are not qualified plan awards. A qualified plan award is one that does not discriminate in favor of highly compensated employees and that is established under a written plan. $1,600 for qualified plan awards. An example of this is Wallace has worked for Financial Court for 10 years. Financial Court makes a qualifying length of service award to Wallace in the form of an engraved silver watch. The cost of the watch was $375. The watch was presented to Wallace during a meaningful presentation. All the company employees are eligible to receive length of service awards based on their tenure with the company. The watch is deductible to Financial Corp as a business expense, and the value of the watch is not taxable to Wallace because it was under $400. I just want to talk about combat pay and veterans benefits. Wages earned by military personnel are generally taxable. I want to talk about Medicare waiver payments. Medicare waiver payments, also called difficulty of care payments, are payments to a taxpayer for home care services provided to a disabled individual living in the same residence and may be excluded from gross income. I want to talk about disability insurance benefits. A taxpayer may also receive long-term disability payments as a result of an insurance policy. As a general rule, long-term disability payments from an insurance policy are excluded from income if the taxpayer pays the premiums for the policy. If an employer pays the insurance premiums, the employee must report the payments as taxable income. And then I want to talk about veterans' disability benefits. Veterans' disability benefits are exempt from taxation if the veteran was terminated through separation or discharged under honorable conditions. And lastly, I want to talk about life insurance payments. Life insurance payouts generally are not taxable to a beneficiary if the payment was the result of the death of the insured. Okay guys, that's all I want to say for taxable and non-taxable income. See my other videos that will be discussing calculating the basis of assets.